Look, I'm not going to say I told you so, but I literally told you so. You see, a few weeks back, I did a video where I ran the numbers on that whole Bitcoin reset strategy theory. Um, and I showed you why it was mathematically impossible. Now, current US national debt, like we said, is about $37 trillion. Current US Bitcoin holdings is approximately 200,000 coins. So, if you wanted to completely cover the debt with Bitcoin, divide 37 trillion by 200,000 Bitcoin and you get $185 million dollars per coin, which is worth 8.6 times all the wealth on earth. Completely absurd. And I said that the real plan wasn't Bitcoin, it was stablecoins. Countries with collapsing currencies buying digital dollars, which drives demand for US treasuries, which in turn keeps interest rates low. It's a financial repression that's rebranded as a service. And now, well, the Treasury Secretary, Scott Bessent, recently stood up at a Treasury Market Conference and called stablecoins, quote, a future, a future pillar of U.S. debt financing. The first Secretary Treasury in history to say that publicly. So let me walk you through what just happened, because when you see the numbers, this confirms everything that I said. Right. So here's what happened. Bessent standing there looking at 38, trillion dollars of US debt. That's up $2 trillion just this year alone. And during that 48-day government shutdown, remember that? When the government was supposedly closed, they borrowed $619 billion. That's 14.4 billion per day while the government was shut down. The only thing that never stops in America, deficit spending. So Besant's looking at this thinking, where do we find buyers, for all this debt without interest rates exploding? And here's what he said, and I'm quoting directly. We are closely monitoring growth in the stablecoin market, which are large investors in treasury bills. And then he goes further. He says he expects stablecoin markets to grow tenfold by 2030, from $312 billion today to $3 trillion, thanks to the innovation made possible by the Genius Act. That's not speculation. That's the US Treasury Secretary outlining their debt financing strategy. And now here's why this is brilliant and also slightly terrifying. You see, stablecoins, whether it's USDC, USDT, all of them, they have to be backed one-to-one with real dollars or US treasuries. That's the whole point. They are stable because every token represents an actual dollar sitting somewhere. So for every dollar of USDC that's created, it equals $1 of demand for US government debt. Now, currently, there's 312 billion in stablecoins. That's 312 billion holding US treasuries right now. If that grows to 3 trillion, well, then that's 3 trillion in automatic structural built-in demand for US debt. But here's the real play, and this is what I was talking about in my last video. It's not Americans buying these stablecoins. It's people in countries with collapsing currencies. So, for example, Argentina. Last year, inflation peaked at 290%. Yeah, 290%. They had strict capital controls. You literally couldn't walk into a bank and get US dollars. The government would not let you. And like I showed in my last video, people then turned to digital dollars. And today, 60% of all crypto transactions in Argentina are dollar stablecoins. So not Bitcoin, not some silly gamble on cryptocurrency, just digital dollars that hold their value while the peso around them, just collapses. Nigeria, Turkey, Venezuela, millions of people in countries with weak currencies are choosing to hold digital dollars instead of their own currency. And here's the thing. That's not Americans buying stablecoins, you see. That's global demand for US dollars that's being created through crypto rails. Every person in Lagos or Buenos Aires that holds $100 in USDC, that's $100 more demand for US treasuries backing that stablecoin. And that demand keeps US interest rates low. Lower interest rates means cheaper debt servicing for the US government. It's genuinely clever. They're exporting dollar demand to countries that desperately need currency stability. And in return, those countries are indirectly funding American debt. That's the mechanism. And that's why Bessent sees this as structural long-term demand, not just some fintech trend. And you see, this is why the Genius Act matters. It's not just crypto regulation, it's the US government creating the legal framework to make dollar stablecoins the global standard before anyone else can. Because look at what Bessent said when the act passed in July. This will expand access to the dollar economy for billions across the globe. Billions, not millions, billions of people. Europe, well, they passed MiCA, their crypto regulation, back in 2024, but their stablecoin market is tiny. There's no euro stablecoin with any real scale. China, well, China seemed to ban crypto entirely. No stablecoin market at all. The UK, well, we are still consulting. We're taking a cautious approach. Well, the central bank governor is a bit more open to stablecoins now. And we are going live with regulations in 2026, which is good. But the US is already 2 years ahead, locking in the infrastructure. So when someone in Turkey or Nigeria or Argentina needs a safe asset, what are they going to use? Most likely American digital dollars, running on American companies, Tether, Circle, all backed by American debt. Now, how does this actually solve the debt problem? Well, let's be honest. It doesn't solve it directly. Is $3 trillion in stablecoin demand enough to solve a 38 trillion debt problem? Absolutely not. Even at 3 trillion, that's less than 10% of total US debt. And the US is adding 2 trillion a year just in new borrowing. And some economists are already poking holes in this. There's this argument that stablecoins just redistributes money. It doesn't create net new demand. The logic goes, if Americans sell their treasury holdings to buy stablecoins, and those stablecoins just buy treasuries, you've just moved the money around in circles. But, and this is important, that's not where the growth is coming from. The growth is coming, like I said earlier, from people in countries like Argentina who couldn't access dollars before, from people in Nigeria converting their naira to USDC because their currency is devaluing, and people in Turkey holding digital dollars because the lira collapsed. That's new demand. These people, they were not buying US treasuries before. Now they're suddenly backing them indirectly through stablecoins. However, is this a magic solution that makes the $38 trillion disappear? No, but it does help to create a new structural framework that helps to keep interest rates lower than they would otherwise be. And remember what I said in my last video. This isn't a quick fix. This is a 15 to 20 year slow debt grind. The debt isn't really paid back in the way you and I would pay back our debt. Really, it just becomes worth less in real terms through negative real rates. And there's, of course, another risk. What happens if a major stablecoin issuer gets into trouble? It's happened before. So when people were talking about, the Bitcoin strategic reserve and using crypto to pay off the national debt, that was never the plan. The plan was always this: create regulatory clarity, legitimize stablecoins, and then use them to drive structural demand for US debt, while at the same time extending the dollar dominance into the digital economy. And Bessent just confirmed it publicly. If you found this video useful, please give it a like. I'll keep tracking how this plays out, especially in 2026 when UK regulations go live. So subscribe if you want to stay ahead of where the money is actually moving, not just where the hype is. I'll see you in the next one. Bye-bye.